Okay, let's move to bond analysis, which would be less complicated than stocks. So bonds, like I said, is basically almost a loan agreement that you sign with high quality um, uh, parties like governments and companies, and it's basically a promise to pay on their part. And the two categories here again are domestic bonds and international bonds. And you can see that over here, Vanguard thinks that having around 20 to 50% of your bond portfolio invested in international bonds is recommended. However, this portfolio just has around 10% in international bonds. There is mixed research here because bonds are kind of harder to predict in that sense. Uh, because right now the interest rate, you may have heard, interest rates are really, really low. They're historically low. In fact, they're negative in some countries. And it's really hard to say what the bond returns would be. In fact, some investors like Charles Schwab think that it really doesn't make sense to invest in bonds anymore. You should just go all out in stocks, but that's more for investors with an aggressive outlook and who are in their 20s or 30s. But it makes sense to have bonds. And to keep in things in perspective, this is just 10% of your portfolio. So you really can't do much diversification within bonds. So it makes sense to go with just one or two low cost funds of bonds. Um, so domestic bonds is basically buying bonds of issued by the U.S. government or like large cap corporate bonds issued by companies like Apple and so on. Um, within US bonds, domestic bonds, there is also the category of taxable versus municipal bonds. So this is, this brings me to the other point of tax efficient investing. So once you figure out the basics of investing, I think the next step is to also consider taxes, um, and how much you're paying right now versus how much you'll pay in retirement. And the idea here is that you should try to uh, place bonds which are usually considered tax inefficient because like they basically pay you income. So all the returns that you get on a bond is like an income and gets taxed at your income tax rate. So it really makes sense to put these in sheltered accounts like a 401k or a Roth account. Um, However, municipal accounts, especially those issued by your state, have no federal or state tax, so they could be placed in uh, your taxable accounts. However, one thing to note is municipal bonds are riskier because they are from a more specific set of uh, state governments or like companies that operate locally in the state. So this actually brings us to a broader point of the more selective that you are in your investments, the riskier it gets, right? So if you think about buying one thing as an investment and not thinking about it at all, uh, which gives you and it should never really be thought of as zero risk because nothing in this in investment is zero risk. It's all relative and there is always a risk adjusted return that you need to calculate, but the more specific that you get, the riskier it becomes. So when you're talking about the US stock market, it's definitely less risky than a specific sector of the US stock market, right? So that kind of connects what I said before about small caps as well as sector funds. Then another metric that bonds usually include is the credit quality, which is basically how every bond is rated to be to indicate what's the likelihood of it defaulting, because like I said, a bond is literally a agreement that is made between you and the issuer of the bond, and it's a promise to pay, but um, the rating indicates how likely the promise will be broken. So usually, if you just buy index funds, they only have the highest rated bonds, which are issued by the government, or like state governments, and those have decent enough return for the risk. Another idea here is of interest rate sensitivity, which is short-term bonds are usually less sensitive to interest rate, because as the interest rate changes over a longer period than the lifetime of the bond, so they are less sensitive. However, if you take like a 10-year bond or even a 30-year bond, you're kind of locked in to the rate, right? However, the interest rate, which basically is controlled by the Fed, the Federal Reserve of the U.S., or and also kind of affects the rates at which banks lend you loans, or mortgage rates, or inflation, is changes over shorter periods than 30 years. So you kind of are taking a risk that you took a 5% bond, but now the inflation rate is 8%, so you're losing money there, right? And then this is similar to what we saw um, in stocks. Uh, and then lastly, there is this tab about costs, taxes, and manager risk. And it's just good to go through this as well. Like I said, these are really the things that are in your control. How the market does is not in your control. You can time it, but that doesn't mean you should time it. Most of the times, if you do well in the market, it is luck. And if you look around, most other people would have done well. And that's something that we miss because of various biases. Um, it was interesting. Recently, a lot of people sold Apple, and it turned out that Apple was the most profitable stock to have owned in the last month, right? So you can see that someone can think, oh, I'm such a genius that I sold Apple at the right time, but actually it was just lucky for everyone. So it really is no skill here, except for the very, very few, right? I'm not denying the existence of this skill. I'm just saying that it really is super hard to time, and you're much rather uh, rewarded going with extreme diversity, which is just buying the complete markets whenever possible. And Vanguard is one of the pioneers who provide you with these funds that are extremely low cost. So you can see here that Vanguard's this portfolio is um, 90 point is let's just say it's a lot cheaper than the industry, which charges you 1%. This only charges 0.07% effectively, right? And this is more of a tax view, a view of tax efficiency in your portfolio. So you can see around 60% of this portfolio is in tax advantaged accounts, and there are some taxable bonds that are in taxable accounts, but there is good reason for that. If you're curious, you can ask in the comments and I can answer. And finally, there is manager risk, but this kind of gets eliminated if you just invest in index funds, because there's no real manager. There is tracking error and stuff like that, but no one is really actively trying to time the market or anything. Finally, you can look at a summary of everything that we just talked about, and it just looks good to have this panoptic view of your portfolio. You can print this report if you like. And yeah, that's pretty much what I wanted to talk about. Just curious to hear about if you have used Portfolio Watch or if you have suggestions on how other things that Vanguard provides. Thank you so much for watching.